One number, one report, one morning. And just like that, $1.3 trillion vanished from the stock market before most Americans finished their morning coffee. Not a war, not a recession, not a banking collapse. A jobs report. That's it. That's all it took to erase 9 straight weeks of gains, the longest winning streak Wall Street had seen in years, in a single trading session. And here's the part that will make you stop and think. The man who saw this coming didn't work at the Federal Reserve. He wasn't a government insider. He was a billionaire investor who stood in front of a camera 2 days before the crash and told the world exactly what was about to happen. Nobody listened. His name is Ray Dalio, and what he said on June 3rd should have been the loudest alarm bell on Wall Street. Instead, it got a few headlines and disappeared into the noise. Today, we are going to break down everything. What happened on June 5th, why it happened, who saw it coming, and most importantly, what this means for your money right now. Stay with me, because by the end of this video, you are going to understand this market better than 90% of retail investors out there. Let's start with Ray Dalio, because if you want to understand June 5th, you have to start on June 3rd. Ray Dalio built Bridgewater Associates into the largest hedge fund on the planet. This is not some Twitter influencer or YouTube trader. This man has managed money through the 1987 crash, the dot-com collapse, the 2008 financial crisis, and every major market event in between. When Ray Dalio speaks, institutions listen. On June 3rd, 2 days before the crash, Dalio sat down for an interview with Bloomberg Television, and what he said was not complicated. It was not filled with technical jargon. It was actually very simple. He said all great technology changes produce bubbles. Every single one, without exception. And the reason they produce bubbles is because nobody can price innovation accurately. Companies feel pressure to spend aggressively to capture market share. Investors pile into the stocks. Valuations stretch beyond what the underlying cash flows can support. And then one day, reality shows up. But here is the line that should have stopped every AI investor cold. He said, "People bet on the technology, which I will also bet on, but they think buying the stocks is the same as betting on the technology. It is not, because the stocks can be expensive. The technology can win, and you can still lose money." Read that again. The technology can win, and you can still lose money. That is exactly what happened on June 5th. AI is not dead. The demand is real. The capex is real. Google, Microsoft, Meta, and Amazon are expected to spend over $700 billion on AI infrastructure in 2026 alone. That number is not slowing down. But the stocks had priced in perfection. And markets do not reward perfection. They punish it the moment anything comes in even slightly below expectation. Dalio's bubble indicators on June 3rd were sitting near levels last seen in the year 2000 and in 1929. That is not a small statement. That is one of the most serious warnings a serious investor can give. 2 days later, the market proved him right. Now let's talk about what actually pulled the trigger on June 5th. At 8:30 in the morning Eastern Time, the May jobs report dropped. The expectation was 80,000 new jobs, maybe 88,000 on the high end. The economy had been showing signs of cooling. The Federal Reserve had been signaling rate cuts were coming. Here is the reality. When the economy is too strong, the Federal Reserve does not cut interest rates. They hold them. Or worse, they raise them. Higher rates mean money becomes more expensive to borrow. And when money is expensive, investors stop paying inflated prices for high-growth stocks that are burning cash and promising future returns. AI stocks are exactly that kind of stock. You are not paying for what these companies earn today. You are paying for what you believe they will earn 5 and 10 years from now. The moment rates go up or stay high, that future value shrinks fast.
Before the jobs report, markets were pricing roughly a 52% chance of a Fed rate hike by December. After the report hit, that number jumped to 68% in a matter of hours. Bond yields spiked, the dollar strengthened, and the most expensive, most crowded trade on Wall Street, AI semiconductors, started getting liquidated at scale. Let's go stock by stock, because the numbers tell the real story.
Nvidia, the crown jewel of the AI trade. The company that became a household name because every AI model in the world runs on its chips. Down 6% on June 5th. That does not sound catastrophic until you realize 6% of Nvidia's market cap is over $300 billion. Gone in one day. Micron Technology, down 13%. $150 billion in market value erased. AMD, down 11%. Marvell Technology, down 17%. 17 in one session. Broadcom was already bleeding from its earnings report 2 days earlier. The company reported AI chip revenue of $10.8 billion, up 143% year over year. That is extraordinary growth by any measure. But their guidance for next quarter came in at $16 billion. Analysts were expecting $16.36 billion, a gap of $360 million on a $22 billion company. $360 million of missed guidance. That is what started the avalanche. Broadcom dropped 12 to 15% after earnings, and that crack in confidence spread across every chip stock on the market. The Philadelphia Semiconductor Index, which tracks the entire chip sector, fell 10.3% on June 5th. That was its worst single day since March of 2020, when the world was shutting down for a pandemic. Total damage across the chip sector, $1.3 trillion. The broader market felt it too. The Nasdaq fell over 4%. The S&P 500 dropped 2.6%. The 9-week winning streak, the longest since late 2023, was over. Now here is the question everyone on Wall Street was asking by June 5th's afternoon. Is this the beginning of something much bigger? Or is this a healthy reset? To answer that, you need to understand history, because this has happened before, twice. The first time was the year 2000, the dot-com bubble. Technology stocks had been on a historic run. The Nasdaq tripled in the space of a few years. Companies with no revenue, no profits, and sometimes no real product were worth billions. The story was simple. The internet is going to change everything. Get in now or get left behind. Sound familiar? When that bubble burst, the Nasdaq fell 78% from peak to trough. It took 15 years to fully recover. The second time was 2022. The Federal Reserve started raising interest rates aggressively to fight inflation. Growth stocks, the same kind of high multiple future earnings stocks we are talking about today, got crushed. The Nasdaq fell 33%. Nvidia alone dropped 66% from its highs that year. Now here is where June 2026 is different from both of those moments, and this distinction matters enormously. In 2000, most of these companies had no real earnings. They were pure speculation. In 2022, the rate hikes were aggressive and sustained. The Fed raised rates 11 times. Today, the AI companies have real revenue, real cash flows, real customers. Nvidia's data center business is generating tens of billions in real income. The demand from hyperscalers is not slowing down. This is not a story built on hope. It is built on actual business. What June 5th was is a positioning correction. Investors had crowded into AI stocks so heavily that any negative catalyst was going to cause an unwind. The jobs report was that catalyst. But the underlying demand story remains intact. Ray Dalio himself made this distinction. He said you can be right about the technology and still lose money on the stocks. The technology is not broken, The valuations were just stretched too far, too fast. So what does this mean for you right now? What should an actual investor be thinking after a day like June 5th? First, understand what you own. If you own Nvidia or AMD or Micron because someone on social media told you AI stocks only go up, that is the most dangerous position you can be in. Because on days like June 5th, those are the people who panic sell at the bottom and lock in permanent losses.
If you own these companies because you understand that AI infrastructure spending is going to be measured in trillions of dollars over the next decade, and you have conviction in the long-term demand, then June 5th was noise. Painful, expensive noise, but noise. Second, watch the Federal Reserve closely. The next major catalyst for these stocks is the CPI inflation report on June 10th and the Fed meeting shortly after. If inflation shows signs of cooling, rate cut expectations will return. And when rate cut expectations return, AI stocks will likely recover quickly.
Third, Broadcom's guidance miss was the real trigger here, not a collapse in AI demand. The hyperscalers, Google, Microsoft, Meta, Amazon, are still spending aggressively. Goldman Sachs estimated AI-related capital expenditure will account for more than 3% of U.S. GDP in 2026. That number does not reflect a bubble bursting. It reflects a build-out that is still accelerating. The smart money that was trimming positions into strength before June 5th is now watching carefully for an entry point. That is not panic. That is discipline. Here is what June 5th really taught us.
Markets do not move on what is true. They move on what is expected versus what actually happens. 172,000 jobs when 80,000 were expected is not bad news for America. It is bad news for a trade that was built on the assumption of falling rates. Ray Dalio warned us that the stocks and the technology are two different bets. Most people did not separate those two things in their minds. June 5th forced them to. The AI revolution is not over, not even close. But the era of buying any chip stock at any price because AI is the future, that era took a serious hit on June 5th. The investors who come out of this stronger are the ones who understand the difference between a great technology and a great investment, between a story and a valuation, between conviction and complacency. Ray Dalio has been right before. He was right in 2008. He was right on June 3rd. The question is, are you listening now? If this video gave you a clearer picture of what is happening in the market and why it matters to your financial future, hit that subscribe button. Because this channel exists to give you the kind of analysis that Wall Street assumes you are not smart enough to understand.
You are, and you deserve to know.